Howdy, Jacob here. Today we're looking at Clean Harbors in the commercial services and supplies industry. 12.1 billion market cap on 14.4 billion enterprise value. They provide environmental and industrial services globally. 1980, incorporated in Massachusetts. Growth does not appear extraordinarily sexy, but you are looking at a 3 to 5% annual revenue growth, and a heavy amount of it has come in the last 3 years. We'll have to see if that was acquisition or organically. Gross margin up a bit, operating margin up a bit, all positive. Return on invested capital kind of low, pretty high the last 2 years at 8 and 9%, but historically in the mid to even low single digits, which is not very impressive. They do not pay any dividends. Balance sheet has 550 million cash-like products, 10 million short-term debt, 2.3 billion long-term debt. Quite a bit of long-term debt, if you ask me. That 2 billion long-term debt in relation to cash flow is a good amount. So it's about 300 million being produced on the free cash flow side, and about 7 times that is what they have in long-term debt. So they have been using a little bit extra for the acquisitions. But yeah, I guess in the rolling 12 even they issued a bit of debt here. So when it comes to debt, and the way I view it is in relation to free cash flow. And so you can either increase free cash flow, decrease debt, or some combination of the both to make it more attractive and much more safe from a margin standpoint from my perspective. And right now, 7 times the free cash flow in debt is quite high. And so I would not want them to be issuing really any more debt unless it's absolutely needed to. We'll see whether these acquisitions were extraordinarily advantageous or not. But we do know that they increased CapEx, increased cash from operations even more, producing more free cash flow. So that's positive. It's just whether these were very solid acquisitions or not. We'll see in a little bit. But I think we're ready to make our assumptions on the revenue growth side. I don't think we're going to see anything super sexy, like I said. We'll assume that they do put a bit of money towards acquisitions, and I think they'll probably be able to go 3% organically, probably 5% with acquisitions. As for margins, they are higher recently. I'm not sure they'll be able to sustain necessarily that high range, but let's do a little bit of a range there. And then for share change, they do repurchase a little bit of shares, and it does more than offset stock-based compensation, but it is pretty small in relation to their market cap, because 1% share repurchases here would be about $100 million, and they buy back half that with stock-based compensation. So maybe just 0.3% for share repurchases based on history. Terminal P at 5% growth rate. I wouldn't necessarily that I know them to have any sort of moat or anything. Maybe they have some sort of dominance geographically, but for me, I'm not entirely sure of that as of this moment. So I'll probably be comfortable going with market average. Terminal P and price free cash flow with a discount rate of 15%. Indies fall 78%. So a couple companies in a row where it's not necessarily at the price point I'm looking for here, but it's always good to research as many stocks possible to see if any of them are at a price point that makes sense to you to look more into. But for me, I don't waste time when something's not obviously attractive. So either way, I hope you enjoyed the video and have a great rest of your day. Thank you.